call of Zensar Technologies Limited, hosted by Axis Capital. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Manik Taneja from Axis Capital. Thank you, and over to you.
Thank you, Ishishri. Good morning, everyone. On behalf of Axis Capital, I welcome you all to Zensar's Q4FY23 earnings call. We have with us today Mr. Manish Tandon, CEO and Managing Director of Zensar Technologies, Mr. Sachin Vute, CFO, and a few other members of the senior management team. Before I hand over the call to Manish, I would like to highlight that the safe harbor statement on the second slide of the analyst presentation and is assumed to be read and understood. With this, I'll hand over the call to Manish. Thank you, and over to you, Manish.
Thank you, Manik. Hello, good morning, good afternoon, and good evening, everyone. And thank you for taking the time to join us today to discuss Zensar's financial results for the fourth quarter of FY23. As Manik mentioned, we have Sachin, our CFO, on the call, and I would also like to welcome Vivek Ranjan, our CHRO, and a very warm welcome to Vijay Sinha, for whom this is the first call and who has joined as a COO a couple of months back. In the 4 months since starting this role, I've had the pleasure of meeting many fascinating people, including Zensar associates, industry thought leaders, and clients who passionately believe in their products and services. With each interaction over these months, I have been reminded why I was so excited to take on this work. At Zensar, we create experiences that put people first. We do more than sell and deliver to our clients. We build relationships with them. And through these relationships, we are always learning more about our clients' drive and desire to serve their customers with greater speed, agility, and purpose. To increase our addressable market, we are looking from the inside out, identifying our key strengths and capitalizing on our substantial service line investments. With the goal of optimizing execution, we also have made a few key changes to our organization structure over the last quarter. Vertical business heads have been given the additional responsibility of driving service line each, helping to create a more collaborative sales environment. The capabilities of Indigo Slate and Foolproof have been consolidated under the umbrella of Integrated Studios. We also have added a new Chief Business Officer position to lead the Integrated Studios and champion our experience-led offerings, which are very unique, by the way. A separate function for net new growth and alliances has been established to focus on strengthening our alliance and hyperscaler partnerships-led business. Our sales incentive plan also has been revamped with an emphasis on the right incentivization to encourage cross-sell, multi-service line deals with healthier margin profiles. With that, I will turn to the summary of quarterly and FY results. For the fourth quarter of FY23, we registered a service revenue of 145.8 million, representing a sequential QOQ growth of 2% in constant currency. This translates to an overall revenue of 147.5 million, representing a sequential QOQ growth of 0.4% and quarterly YOY decline of 0.3% in constant currency. For the full FY23, we registered revenues of 604.2 million, representing a year-over-year growth of 10.3% in constant currency. Let me walk you through the performance of our geographies and verticals for the quarter. All numbers stated here are in constant currency. Banking, financial services, and insurance reported sequential QOQ growth of 2.4% and YOY year-over-year growth of 16.1% in constant currency. Last quarter, our insurance verticals saw a decline due to right shifting of milestones at a key client, which we recognize in the current quarter. High-tech and manufacturing, including emerging, registered sequential QoQ growth of 4.2% and year-over-year decline of 4.1% in constant currency, supported by furlough reversal and growth in revenues at some of our key manufacturing clients. Consumer services registered sequential quarter-on-quarter decline of 12.7% and a year-over-year decline of 17.2% in constant currency, primarily due to decline in revenues at one of our key clients in the Europe portfolio. We expect to recover this revenue in the next quarter. At a macro level, we are still seeing headwinds in this vertical in pockets, and retail clients have tightened budgets for capital projects in response to continued high inflation and economic uncertainty. Coming to regions, the US region posted a sequential quarter-on-quarter growth of 1.4% and a year-over-year decline of 3.8%. The Europe region registered sequential quarter-on-quarter decline of 5.7% and year-over-year growth of 1.1% in constant currency. However, for the full FY23, this region grew by a phenomenal 20% in constant currency. The decline in revenue this quarter is due to the right shifting of revenue recognition at a key client. While there is continued softness in the new business environment, we saw healthy growth at several of our existing clients, and we expect the overall growth in this region to be back in Q4FY24. The South Africa region saw good momentum with sequential quarter-on-quarter growth of 4.3% and a year-over-year growth of 20.7%. Growth for full year FY23 is 18.3% in constant currency. In addition to our existing AMS core positioning, the region saw sustained positive traction for our experience-led engineering and cloud-native capabilities, which has led to ramp-ups at some of our key clients. Our gross margin stood at 31.9% in Q4 FY23, representing a sequential quarter-over-quarter increase of 460 basis points. Our EBITDA stood at 14.5%, a sequential quarter-on-quarter increase of 320 basis points. The order book for Q4 FY23 stood at 174.9 million, supported by healthy renewals and multiple wins across verticals. I am pleased to share that for the fourth quarter, our last 12 months attrition declined to 19.8%, a sequential improvement of 300 basis points. Attrition continues to moderate due to our strong employee-centric policy, coupled with easing supply-side issues. Our employee happiness index, an integral RPG employee satisfaction metric, has reached a score of 84%, an improvement of 200 basis points over the last year. Likewise, we have seen a 20% increase in annual average training hours per employee, rising from 61.8 hours last year to 74.2 hours in FY23. Our service lines continue to scale up and deliver targeted high-value solutions. Our integrated solutions approach, which leverages cross-service line capabilities like experience in engineering, is gaining a strong foothold with our clients. Our focused service lines, including advanced engineering services, data engineering and analytics, and enterprise SaaS, are growing quickly and now constitute 34.4% of our services revenue. On the ESG front, I'm thrilled to share that the global level green energy component for our premises has increased to 17.6% compared to 7% last year. With this, we increased our green energy contribution by almost 150% in 1 year.
I'm sorry to interrupt, sir. This is the operator here. The voice is a little muffled, so can you stay away from the speaker a little, from the microphone?
Okay. Is this better?
So can you speak, please, so that we can check?
Is this better?
Yes, sir. Please go ahead.
Okay. So as I was saying, with this we increased our green energy contribution by almost 150% in 1 year. We are also water positive, with water regeneration exceeding water consumed by 120% on our Pune campus. Importantly, in FY22-23, we touched more than 200,000 lives through fever clinics and other education and communication drives in CSR. The current demand environment continues to be challenging, driven by global uncertainty. This will delay client decision making and impact tech spend in the near to medium term. As a result, we are seeing some slowdown in pockets, particularly in high-tech and manufacturing and in consumer services verticals. However, as our clients navigate the uncertainties, we are looking to digital transformation to move forward with velocity. As a steadfast partner, we continue to provide design, data, and engineering offerings to help meet and redefine the challenges that matter most to the clients we serve. In conclusion, I want to reiterate that we are on the right path in terms of strategy. We continue to keep a laser-sharp focus on execution to deliver added value for all our stakeholders while keeping our clients at the front and center. With that, I will now invite Sachin, our Chief Financial Officer, to provide an update on critical financial data, after which we will open the floor for questions.
Thank you, Manish. Good day, everyone, and thank you all for joining this call. In addition to Manish talking about the business, I will take you through some of the key financial metrics for the year and for the quarter ending March 23. For the financial year 23, the reported revenue in US dollar terms stood at $604.2 million, reflecting growth of 6.1% year on year. In constant currency, the growth for the year was 10.3%. The reported revenue for fourth quarter of FY23 is $147.5 million in US dollar terms, reflecting growth of 1.1% sequentially. In constant currency terms, revenue growth for the quarter is 0.4% sequentially. Services revenue for the quarter grew by 2.7% sequentially in reported terms and 2% in constant currency terms. We exited Q4FY23 at an EBITDA of 14.5%, an increase of 320 basis points from previous quarter. Improvement in EBITDA for the quarter was primarily driven by positive impact of currency, improved trade mix, ongoing operational efficiencies including optimization of subcontractor costs, improved productivity, and better utilization on account of furlough reversals. It was partially offset by increase in SG&A cost. Increase in SG&A cost was primarily due to reversal of one-time benefit which we had last quarter. There was reduction in depreciation expenses, the primary reason for optimization in portfolio of lease assets and intangibles as part of our cost optimization initiatives affected the number. Going ahead, we see some variation, but expect the same to be in range bound for the rest of the year. As we have emphasized earlier, our continuous rigor for margin improvement through measures such as increasing fresher deployment, improving commercials, optimizing operational metrics, and rationalizing costs has helped in improving the company margin. LTM attrition for Q4 stood at 19.8%, which is lowest among the recent quarters, has helped us manage the costs better. We have had one of the best DSOs in recent quarters as collections were healthy for the company. For the quarter ended March 31st, 2023, DSO stood at 74 days as against 80 days in previous quarters. Year-on-year basis, DSO improved by 16 days. For the quarter, cash and cash equivalents, including investments, stood at $201.5 million, $22.1 million increase from last quarter, and $45.8 million increase year-on-year. The effective tax rate for the quarter was 26.2%. The Board of Directors has recommended a final dividend of rupees 3.5 per share for FY23, subject to approval from shareholders. With this, the total dividend payout, including interim dividend for FY23, will be 250% of face value. With that, I come to the end of my presentation and open the house for questions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We have a first question from the line of Nitin Padmanabhan from Investec. Please go ahead.
Yeah, hi, good morning everyone, and I think the quarter has been sort of exemplary from an execution standpoint. Now Manish, just wanted your thoughts from a demand perspective because while margins have done extremely well, the demand commentary is soft in the context of the environment, which is understandable. But we have seen high-tech grow this quarter. Just wanted your thoughts on what you're exactly seeing within each of those verticals. Do you worry about sequential declines or from a demand perspective, or how should we think about each of those elements for each of the verticals?
So I think, Nitin, first of all, thank you for the kind words. I agree that we have executed well as a team this quarter, and hopefully this trend will continue. As far as the demand is concerned, my larger peers have already spoken that the demand environment is soft, and so on and so forth. But I can say that what we have done in the last 1.5, 2 years is increase the addressable market for our services. So even though the market as it existed for us might have reduced, the overall addressable market has increased for us. And that is the way I am looking at things, and my team is looking at things. We had a very, very good quarter, orders looking at close to 175 million, which bodes well for at least the next quarter. As far as verticals are concerned, we will continue to see challenges in CS, consumer services, and high-tech. BFSI, actually, our portfolio is tilted more towards insurance. So we are not seeing as many headwinds as some of our competitors. The other geographies, UK, we are seeing UK and Europe, we have, I think, built very deep relationships over the years with the clients, so we are seeing continuous growth there. And that is also the case with South Africa. So those two remain bright spots from a demand perspective even now. I hope I've answered the question.
Sure. And just another question on, you mentioned right sizing or sort of right shifting of revenue recognition with the customer in Europe. Does that pertain to the pass-through, or how should we sort of think about that?
No, this is not pass-through. This is services revenue. When we just missed the cutoff for receiving a document, so we had to shift that revenue got shifted to the next quarter. And this happens with some account, or we had that every quarter. So it's nothing very material that you should be worried about, or I should be worried about.
Sure. And lastly, on margins, just your thoughts on, do you think this is sort of base margin, and considering the pass-through that has come off quite a bit from what it used to be, do you think longer term margins can be higher than what it used to be, at least technically? speaking, considering that the pass-through is not going to be there, so maybe longer term it can technically be higher, and are these margins sort of defensible from where it is today? That's the last question. And Manish, your voice is a little muffled. I don't know why, but yeah, it's a little difficult to comprehend.
Okay. Is this better?
Yeah.
Okay, so on margin, I would request Sachin to provide the commentary. And what was your last question, Nitin? I missed it.
No, it was primarily on the margin, on sustainability. Is this sort of the base? And two, considering that pass-through is significantly lower than what it used to be, and if it is, if that's going to be the direction on pass-through, ideally shouldn't margins longer term technically be higher than what it used to be from a company, longer term, that is, not talking about a year or any such thing, but just longer term, just from a thought process perspective.
So just before I hand over to Sachin to answer your question on margin, I just want to emphasize the point on pass-throughs. Where pass-throughs are absolutely necessary for services revenue to accrue, we are okay with that. But where pass-throughs are just serving as tax calories, adding nothing to the bottom line, we don't want to encourage that. So, in a nutshell, we are focused much more on services revenue, and pass-through revenue we take if and only if it is both margin and service revenue accretive. So that is the change in strategy. I would let Sachin answer your question on sustainability of margins.
Thanks, Manish. Thanks, Nitin, for the question. As you saw, Nitin, our margins improved by 320 basis points during the quarter, primarily due to 30 basis points impact of currency, improved trade mix of another 30 basis points. Ongoing operational efficiencies improved margins by 230 basis points, including subcontractor cost optimization and improved productivity. Given that these are fundamental changes which are happening in the way we are working on our delivery organization, our objective would be to maintain the mid-teens trajectory for our EBITDA margins going forward.
Perfect. That's very helpful, Sachin. Thank you so much. Thank you, Manish. All the very best.
Thank you. We have our next question from the line of Chirag Kacharia from Ashika Institutional Equities. Please go ahead.
Hi. Congratulations on really very good margins in a challenging time. And in terms of revenue growth, I understand the current environment, so I don't want to ask anything on it. But I just want to know, you mentioned that the operational efficiency helped in the margin. So can you throw some deeper light, like what kind of operational efficiency that helped, and also the trajectory going forward? So these margins are sustainable, and we will see a further up momentum in this margin profile. And another question, you mentioned that the 3 clients that resulted into lower growth in this quarter. So, and you also mentioned that in coming quarters we are confident that we will recover the revenue. So I just want to know which are those clients, and why we confident that we going to recover the revenue in the subsequent quarters. Yeah, that's a few questions from my side.
So, margin, again, I will let Sachin take that question. We had articulated the 6 levers that we are using, and Sachin can throw more light in it. I typically don't mention clients, so I don't know which 3 clients we are saying we will recover revenues. Recovery of revenues, I think I said only for those clients where we couldn't recognize revenues because of lack of proper documentation. So, as you know, there is a cutoff, and if you don't receive adequate purchase orders or statements of work and so on, from a financial prudence perspective, we don't recognize that revenue. So that I'm saying we will recover. That's all. Sachin, you want to answer the question on margins?
Sure, thank you. As I said, the subcontractor cost optimization really resulted helping the margins to improve this quarter. Apart from that, if you see the utilization for the company also improved, which has helped the margin for us. And as we have previously also stated, there are 4 to 5 levers which currently we are working on inside the company to improve the margins, improving the service mix of the business, improving the commercials with the customers. We are also improving the pyramid in the company. Also, a lot of focus is being put on optimization of support cost related activities. So we believe that we want to maintain the mid-teens margin trajectory going forward, and these initiatives we believe will help us to maintain it around that.
Thank you. All the very best.
Thank you. We have our next question from the line of Nikhil Chaudhary from Nuvama. Please go ahead.
Hello, good morning, sir. Thank you for the opportunity. My question is regarding the growth in top 5 clients. Very strong bounce back from last quarter contribution and grew more than 8% this time. Just want to understand if it was led by our top client and that also drove our high-tech growth. Is it a fair understanding? And how sustainable is this growth going forward? Thank you.
So I think
I request you to, Mr. Tandon, we are unable to hear you clearly. Give me a moment, please. Participants are requested to stay connected. We have Mr. Tandon back online. So please go ahead.
Yeah, so as I was saying, one of the basic tenets that we have been working on is improving our client centricity. And if we do a good job of that, that should be reflected in the growth of our top accounts, top 5 accounts. I am happy to report that, some of the efforts that we put in are bearing fruit. And we will continue to have client centricity as one of our core tenets as we go forward.
Thank you, sir.
Thank you. We have our next question from the line of Mukul Garg from Motilal Oswal. Please go ahead.
Yeah, hi. I hope I'm audible. Hello?
Yes, sir. Please go ahead.
Yeah, hi. Hey, Manish. So, 2 questions. One for, Manish and Sachin. Manish, just to follow up on the high-tech and, top 5 client growth. you guys have in past indicated that the top account growth will, given the relationship, will remain kind of behind overall business growth. This quarter definitely seems like an exception, but I just wanted to get a sense when you spoke about creating greater potential for business and adding newer areas. Is that something we should think about from top account perspective as well? And that growth can potentially be meaningful going forward.
So we do not comment on individual clients per se. And I don't remember, at least I have never mentioned about top client growth and so on. We've always talked about top 5, top 10, top 20. As I said, I will not comment on a single client overall. But yes, the answer to the latter part of your question is that yes, if we are taking additional service offerings to the market, then if our existing client base is not willing to consume those services where we have the relationships, then how would we expect others to take up those services? So it's a very good leading indicator if our existing client base is taking up the newer offerings. And we are obviously seeing that as we progress through the year.
Sure. So maybe if I can just, for the first half of this question, kind of look at it slightly differently. High tech has been an area where a lot of your peers, have really struggled of late because, it's very visible the kind of issues the sector has been going through globally. This quarter obviously was very good for you, and partially obviously last few quarters were weaker. So is that something we should think about from a going forward perspective also, or was that partially a normalization of revenues after a few weak quarters? How should we think about high tech from next 3 to 4 quarters perspective qualitatively? I don't not expect you to give a quantitative number, but how should we think about it?
See, high tech between Q3 and Q4 always should be going up, because in high tech accounts there are lots of furloughs that happen in the in the last week of December and the first week of January. So and the furlough impact is much more in December than in January. So you should always be seeing growth in high tech. Mostly you should be seeing growth in high tech because of having less furloughs in Q4. So if others are reporting degrowth even after that, there is something to be worried about.
Sure. And the other question was for Sachin. If you look at, I think the margin performance was really great this quarter. The subcon number, the percentage of revenue is now back to where it was 8 quarters back. You guys have also been reporting net declines in employees for last 4 quarters. While you do expect margins to remain range bound and mid-teens over next going forward basis, but how should we see the overall mix change now? Will you get back to employee additions as revenue growth kind of comes back over the next few quarters? How should we think about the compensation perspective? Is subcon, does it still have some more scope to go down?
So thanks Manish for that question. Yeah, Manish, go ahead.
Yeah, I would let Vijay answer that question, Sachin, if you're okay with that.
Sure.
Yeah, thanks, Manish. I hope you can hear me. So With regards to the headcount, right? I think while it is true that our overall headcount has reduced, our build headcount has actually increased in Q4 as compared to Q3. So we believe that with the little bit more improvement in utilization, we will continue to basically add volume growth. With regards to your second point about subcontractors, we will be very methodical in terms of leveraging subcons going forward, so that we leverage only to complement where we don't necessarily have immediately available skills. So there is a little bit of scope for further improvement further reduction in terms of subcontractors as we go forward. And that is a lever that we constantly look towards managing, because that impacts margins.
Sure. Thanks for answering the question. I'll get back into the queue.
Thank you. We have our next question from the line of Dipesh Mehta from Emkay Global. Please go ahead.
Yeah, thanks for the opportunity. One question is about the addressable market expansion, which you earlier indicated. So can you just give us some sense about what steps we have taken to expand our addressable market, and if any qualitative, quantitative way, if you can help us understand it? Thank you.
So yes, of course. So 2 years back, if you look at it, we had primarily two service lines. One was infrastructure management, and the second was ADM, which is application development and maintenance. Over the last 2 years, we have added some of the newer technology areas as service lines. So software as ESAS, for example, is one line, and we are doing very well there with Salesforce, which is a brand new practice, with SAP and with Oracle. The second area that we have added significantly to is data. So there are, as you know, with AI and even before AI, data and analytics was one of the key spend areas, and we were not addressing that spend area effectively. So we have added that service line, and we are seeing good traction there. We also added advanced engineering services, which is basically around using agile technologies and the new technologies that are out there, including cloud technologies. And finally, we created a service line called Experience Services, which helps us, design, research, design, implement, and adopt end-user experiences. Collectively, these services, as was mentioned, add about 35% to our revenues. So that is what I meant by increasing the addressable market.
Understand. And to expand the presence in these expanded service offerings, what portion of it, let's say, through M&A you intend to expand it faster, or you think organically largely we can expand this addressable market, and any new areas where you intend to invest to expand addressable market further? Thank you.
We may add a vertical or two, but we are looking at M&A more opportunistically rather than making it a core part of our strategy, because frankly, in my 30 years in the industry, I can tell you inorganic revenue is no substitute for organic growth. If an organization cannot grow organically, then just doing more M&A just doesn't help. So we are looking at, as I said, execution and improving our execution on our strategy. And as a part of that, if we see opportunistic
opportunities coming up in M&A. And by the way, we actively scout for M&A opportunities, which are attractive, which provide attractive returns to our shareholders. We will go for it.
Understand. Thank you.
Thank you. Ladies and gentlemen, to ask a question, please press star and one on your phone now. We have our next question from the line of Manik Taneja from Axis Capital. Please go ahead.
Thank you for the opportunity, and once again, congratulations for the solid execution. I had a question related to our headcount metrics. Given the moderation that we've seen or the decline that we've seen at an overall level, I was also inquisitive about the decline in terms of the sales and support headcount this quarter. So just wanted to get your thoughts as to how do we see this going forward. And the second question was for Sachin. In terms of our segmental margins, we have seen our IMS margins move up significantly through the course of last couple of quarters. So is this just the hardware or the pass-through element that's driving that? It will be helpful to understand that. Thank you.
So on the first part of the question, I can clearly say that we are not reducing sales headcount or sales expenses. We are actually increasing our sales and marketing expense. But whatever cuts or otherwise you are talking about that you see is not in terms of overall cost, but in terms of driving more efficiencies and having the right people at the right positions. So to answer your question, none of this margin improvement has actually come from reducing sales and marketing expenses. Because if we need to grow revenue, and if we need to be client-centric, which we want to, we need feet on the street. And that is a wrong expense to cut. On the overall numbers for employees, I would request Vivek Ranjan, our CHRO, to take that question.
Thanks a lot, Manish. Thanks for the question. So on overall headcount, something which Vijay already spoke about. So just touching on what he mentioned, our focus will remain utilization of our available talent. And as Vijay also highlighted, utilization has improved, but there is still some more room in terms of improving that. And we will stay focused in terms of ensuring that our billable headcount increases without need for increasing the total headcount. However, the net headcount is a factor which is a factor of business demand, and we'll stay focused on that.
Sure. Thank you. And the second question was for Sachin on the segmental margins.
Yeah. So, Manik, as you rightly said, given that the pass-through revenue for the company over last 3 quarters has been declined, that is the reflection of improvement in the margins which we are seeing. As well as you know, that we have seen a reversal of furloughs, especially in this quarter. That is also a reflection in the spike in the margin over there. Thanks, Manik.
Thank you, and all the best for the future.
Thank you. We have our next question from the line of Sandeep Shah from Equirus Securities. Please go ahead.
Yeah, thanks for the opportunity, and congratulations on a very strong execution. Manish, first question is, post you took over, you highlighted 2 strategies in terms of turnaround. The first, near-term focus in terms of margin turnaround, where we have done a great execution, and it looks like the low-hanging fruits could be largely behind on margin. The second, in terms of the revenue growth turnaround, so can you throw some light? How are we making sure that what we have seen, the successful journey in terms of margin, may even continue in terms of a successful journey in terms of the growth turnaround? May not happen in a near term, but over medium to long term. Just wanted to understand to make the company much more consistently growing on a longer term as a whole.
So, frankly, I believe in the Keynesian quote that in the long term, all of us will be dead. So like in the last call, we had promised that we will get to mid-teen margins by Q2 of FY24. We have actually achieved that number in Q4 of FY23 itself. This gives me as a CEO a lot of confidence in our ability to execute. And again, I watch the short-term improvements that we want to see. And one of the things that I saw, which you may not have noticed as much, was that our order bookings increased from 135 million in Q3 to about 175 million in Q4. I may be off by a couple of million here or there. Now that is a very positive sign overall as far as I am concerned. So I continue to look at leading indicators, and I will continue to make sure that that we continue to execute on our promise on the revenue side also. As you know, the market is tough, as my larger peers have indicated. We have taken certain steps. There is a push and pull. Hopefully, the push that we are making will win over the pull.
Okay. And in terms of your GTM restructuring, you said the vertical heads would be also responsible for services. It was slightly bit unclear. Your voice was muffled. So can you throw some light? And second, Zensar has a good quality murky account list, especially within top 20 clients. But we also hear from peers in terms of a risk of a vendor consolidation, which is happening because of the clients focused on a cost account deals. So are we witnessing any such risk in any of our top clients, and how do we see that risk to pass going forward in terms of our positioning with those clients as a whole?
So I have been in this industry again for 30 years. I can tell you vendor consolidation is always a zero-sum game. Okay? If someone is telling you that through vendor consolidation they are going to grow 10%, I think I would take it with a bag of salt. When vendor consolidation happens, you win some, you lose some. Normally it turns out to be a zero-sum game, right? And I think we have actually very sticky clients, long-term clients who have been with us for several decades, I would say, and have been through 2001, 2008, and now 2000 through COVID, and they have stuck by us. So I hope to take market share away from others in this vendor consolidation rather than cede market share with them.
Okay. And a question in terms of the vertical heads with looking at services?
Yeah, vertical heads. So see, actually, if you look at the organization structure, there are 5 revenue units. Think of them as verticals. So we have 3 verticals in the US, then we have Europe, and then we have South Africa. So those are the 5 revenue units, and we have 5 or 6 service lines. So infrastructure management services, data engineering and analytics, and so on and so forth. So what is meant by that statement is each of these revenue service line leader is also incubating and driving sales for a particular horizontal across the company, right? So think of it as an additional responsibility that they have, not only for their own revenues, but also to drive the revenues of a particular service line across the organization. So think of it as that, sir.
Okay. And Sachin sir, just wanted to understand when would be the wage hikes as a whole, and despite wage hikes, we still believe we can continue to have a mid-teen kind of a margin.
So, as you know that, we have our wage hike cycle starting from Q2 of any financial year. So, that will continue to happen during that period. And as I said, mid-teens is a range, and we are trying to see that how we can keep our EBITDA margins in that range.
So, thanks and all the best.
Thank you.
Thank you. We have our next question from the line of Mihir from Carnelian Capital. Please go ahead.
Hi. Thanks for giving the opportunity, and congratulations on a great set of numbers. I look at the top 5 and top 10 accounts have grown really well. So just wanted to understand, what is the kind of interaction that we are having in top 5 and top 10 accounts. So if you can just throw some light, what kind of interaction are we having across these accounts. And my second question was on the pass-through revenue. We saw pass-through revenue declining over the last 2-3 quarters. If you can just quantify that and, quarter by quarter as to what was that number, that will be really helpful. And my last question was on the roles which are being created. At the starting you mentioned that some new roles which have been created, particularly on the integration side and synergy side. So at that point in time the voice was slightly muffled. If you can throw some more light on that, these roles, that will be really helpful. Thank you very much.
Okay. Sachin, do you want to take the first two parts of the question? I think one was top 10 and the...
Yeah, sure, Manish. So, top 10, obviously one of the major reasons is reversal of pass-through revenues, reversal of furlough revenues which happened during Q4. That is definitely something which has affected the growth in top 10 clients for us. As far as pass-through revenues are concerned, in Q2 we had $6.6 million pass-through revenue. In Q3 we had 3.9, and in Q4 we had $1.7 million of pass-through revenue. But I just want to clarify one thing, that ultimately pass-through is part of our services business. So wherever it's required, pass-through will be there as part of our portfolio as it's linked to any other player in the industry. Thank you.
Sure. And just a
question on new roles or something.
Yeah, yes.
Sorry, you spoke so fast I couldn't understand. If you could repeat it, please.
Sure, yeah. So I just wanted to understand, you mentioned about new roles being created, largely on the integration side, on the delivery side. So which are these roles? And, if you can throw some light on that.
So we have a new Chief Operating Officer in Vijay, which is on this call. We have created an experience service line, which is basically integrated studio services. We have a Chief Business Officer appointed there. We have created a new organization for net new and alliances. So we have created a new role for that. So those are the primary roles that I am talking about here.
Sure. So just an extension to the earlier one. In the top 5 and top 10 accounts, so what is the kind of interaction that you are having? What kind of revenue growth could be there? Just from a qualitative angle, not a quantitative question.
So we have very deep relationships typically with our clients. I have visited now all the 3 main geographies that we operate in. And I can tell you that, we have connects at the CXO level in almost all these accounts. So the kind of interactions that we are having in these accounts are what we normally have at the CXO level, where we talk about, what's new and how we can help our clients' business succeed and compete and get new revenues and improve margins and so on using the latest and greatest technologies, how we can help them save costs. So mostly the discussions have been, at least my discussions are more at a strategic level, and then applying that to the technology solutions that we can bring to bear.
Sure, that's it from my side. Thank you very much.
Thank you. We have our next question from the line of Amit Chandra from HDFC Securities. Please go ahead.
Yes, sir, thanks for the opportunity. So my first question is on the top 5 and top 10 clients. So is it fair to assume that the top 5, top 10 clients growth is largely due to the top client, or is it more like widespread across clients? And also on the cross-sell opportunities that we have within our top 10 strategic accounts, because we have introduced new service lines. So what kind of cross-selling are we doing, and what is the opportunity we see from there in the top, say, 20 strategic accounts?
So, Amit, thanks for that question. Good to hear your voice again. I think, again, as I said, the growth that we are seeing is secular. It is not concentrated growth. So that gives us more confidence that this growth can be more sustainable. So it is not that suddenly one account has woken up and is doing something, and no, that's not the case. One of the things that I have talked about in the past has been our client farming strategy, and I think that strategy is bearing fruit. And again, I would take you back to the order book number, which has increased significantly from 135 million or so to about 175 million. And cross-selling is happening. In fact, our service lines, the newly added service lines, are going much faster than the traditional ADM and infrastructure services.
Okay. And so on the subcontracting expenses, so we have seen a sharp cut in this quarter. And also, if you see in the past, we have seen such volatility in the subcon expenses, and there has been cuts also in the past, and then again it has scaled back. So how confident are we that this time it will sustain at these levels, and what led to such sharp decline in the subcon expenses this quarter? If you can give some more color, it would be helpful.
Yeah. So first of all, I just want to emphasize that we are improving margin by cutting fat, not cutting muscle. And as you can see, subcontractors has improved, utilization has improved. So it is factors like those that are impacting this, and hence I believe that it is more sustainable. At a deeper and a more philosophical level, the structure now in the organization is that of empowerment and accountability. And the targets for margins and the ownership and the accountability goes much deeper in the organization. And of course, I would be remiss if I don't mention that Vijay has done a tremendous job in making sure that all this fat is first found and then cut, including subcontractors.
Okay, sir. Thanks, Anup, and all the best for your future. Thank you.
Thank you. Ladies and gentlemen, that was the last question for today. I would now like to hand the conference over to management for closing comments. Over to you, sir.
So first of all, I think thank you for all your questions, all your efforts, all your praise, all your probing. I think it's not only about these questions for us is not only about giving you answers, but also about thinking carefully as to what our investor base is thinking and looking at. And from that perspective, this call was really useful. From a commitment perspective, I can say that we will continue to work hard to make sure that we service our shareholders and serve them well. Thank you.
Thank you, sir. On behalf of Axis Capital Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.